The rise of so-called populism, which seems to have its roots in the UK's Brexit vote in June last year, has seen Donald Trump come to power and is looking like it could shake up European politics this year. While none of the European elections this year is expected to produce anything like a majority for any of the far-right populist candidates, there's a perceptible shift across the political spectrum. Well, now, the big question is, how do you trade this? Well, James Butterfill joins us now from ETF Securities to take a look in some more detail about this. And let's start off with that question about populism and what it is and how it shapes markets.
Populism is a form of political expression employed selectively and strategically that target issues of mass appeal. Populism, why is it occurring right now? We believe it's to do with quantitative easing. Quantitative easing has led to an increase in inequality. Those wealthy people typically can invest in stocks and shares, whereas less wealthy people can't. And so we've seen that QE increases valuations of equities, and so we've seen this divergence occur. The end result is a lot of disenfranchised people who believe the remote elite is running their country, essentially. And it's led to the British referendum in favour of Brexit last year and Donald Trump, for instance. And this year we already have, it's now Europe's turn for populism. We have the Netherlands and France and Germany this year to worry about.
Unlike the Brexit vote, which went 52 to 48 in favour of leaving Europe, the elections this year, the political elections this year in Europe, none of them seem, at the moment at least, to be able to produce a majority populist candidate. Yes, they may win, but they'll win with a minority vote, share vote.
That's absolutely right. I mean, our suspicion is that while Geert Wilders is talking about banning sales of the Quran and closing down mosques, etc., and leaving the EU, the coalition will be very small, and therefore he won't be able to implement many of these changes. And the same in France. It looks like second round Marine Le Pen won't win, but markets at the moment are pricing in the risk of them winning. If you look at French OATs, they've really blown out relative to German Bunds, for instance. So ultimately, populism is ringing alarm bells in Europe, and it's creating some sort of exacerbations in various asset prices. But therein lies perhaps an opportunity, but certainly it creates a lot of volatility, this populism.
Well, let's look at that opportunity in the markets, because if you look at the progress, I think it's right to say, the British economy has had since the Brexit vote, which has surprised many. I mean, you go to George Osborne's speech before the vote, and you'd have thought that if we ended up the way we have, the whole economy would have fallen apart by now. We'd be a massive recession and so forth, but we're not. Now that, I suspect, is going to ring some interesting bells across Europe when some people go to the polls. They said, well, the UK is doing well.
We expected a much weaker UK economy and a much greater damage, I think, to UK confidence. This just hasn't happened. Part of the reason is that the weak sterling, a 20% drop, has led to a real boon for exporters, for instance. But it's important to remind people that we haven't left Europe yet. The referendum's occurred, Brexit hasn't occurred yet, and that's still going to cause a lot of worry. So whilst we've seen, for instance, sterling reach perhaps a floor, there's not that much upside. But it's a very complicated situation because Europe now has its turn for populism, and it will make markets jittery at the points when, we have the Dutch elections on the 15th of March and the French elections in April and May. There will be these sort of momentary crisis points that will cause market panic in Europe too. So ultimately the net result is extreme volatility in currencies, and we're seeing in our currency ETFs, for instance, we're seeing the emergence of currency vigilantes. Essentially, they express their worries about a country through the currency rather than government bonds, which they used to do historically. So ultimately, it'll lead to real volatility in currencies. Some investors are using that to hedge risk. They're buying, for instance, long euro, short sterling. Some did prior to the referendum last year to hedge risks in their portfolios.
How much of a risk do you think there is to the equity markets at the moment? Indices in some areas trading at record highs. We've seen, I think, almost a near record run for the Dow and the S&P in terms of records. We're not too far away here in London for the benchmark. We've seen a record high in the FTSE 250, and it's been pretty good across many of the European equity indices as well. I mean, how do you square this with what's happening? Are we overextended at the top?
markets move for different reasons. In the United States, it's on the promise that Donald Trump will deliver on a lot of his tax cut promises, a lot of his infrastructure plans. Ultimately, we believe tax cuts will be delayed in the United States, as will the infrastructure plans. And we're already starting to see the deflating of this sort of Trumpflation that occurred very late last year. So ultimately, there will be disappointment in the United States. If you look at it in context of valuations in the US equities, they look extremely expensive. They're trading on around 28 times price earnings at the moment. That's well above the 19 times average. In the UK, 65% of revenues in the FTSE 100 are derived from outside of the UK, so they're in a foreign currency. A 20% depreciation in sterling flatters the earnings, and there's a very close correlation, inverse correlation between the FTSE 100 and sterling, so it's very, very much currency linked. In Europe, it is an interesting story. If we believe that populism will occur, but we won't see the extremist parties such as Marine Le Pen get in power, what we're seeing is an improvement in the macroeconomy in Europe. We're seeing a pickup in PMIs, that's corporate confidence. We're seeing a pickup in loan growth, for instance, so businesses are starting to work again. So ultimately, we feel in Europe, actually, they're still attractively valued, and particularly relative to the United States, is a continued interesting trade.
What's the way through if you're a very risk-off sort of person? What should one be buying? What ETFs are out there that gives a certain amount of protection?
So the theme of populism historically has led to inflation. Governments spend more, it increases government deficits, so it creates a sort of boom-bust cycle. This increased inflation through tax cuts as well is caused by increased consumer spending. Ultimately, it leads to investors flocking to more safe haven assets. So we've seen, for instance, this year to date, nearly $500 million of inflows into our gold products, a classic safe haven. But we also think that the onset of inflation is likely to lead to continued flocking investors into real assets. So that is equity to some extent. We've already seen that. Property is another sort of real asset. Gold and inflation linkers is another interesting trade right now.
Yeah, okay, all right, so some of the interesting trades. Thanks indeed for joining us. James Butterfill there from ETF Securities with a word about this rise in populism. As James was saying, the first election comes in the middle of March. In fact, it coincides with the FOMC decision on US interest rates, which itself could also be an interesting point of reflection.